This is Bloomberg Wall Street Week.
The global push into infrastructure, breaking the IPO logjam in tech.
The financial stories that shape our world.
Cutting inflation without losing jobs. Do we need rate cuts? And if so, how many? Investing in a time of geopolitical turmoil.
Through the eyes of the most influential voices.
Ken Rogoff, economist of Harvard. Former FDIC head Sheila Bair. GE CEO Larry Culp. San Francisco Fed President Mary Daly.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Tesla moves forward after all. Goldman finally gets out of retail, and everyone's trying to figure out where inflation is headed. This is Bloomberg Wall Street Week. I'm David Westin. This week, Wes Edens' Brightline breaks ground on the nation's first truly high-speed train line.
This is now the beginning of the high-speed rail industry in the U.S.
Sir Clive Gillinson of Carnegie Hall on what it takes to make one of the world's great concert halls not only survive, but thrive.
You always go for the vision, go for something that is irresistible.
And Tony James of Jefferson River Capital on making sure New York's Metropolitan Museum of Art doesn't turn into your grandmother's attic.
We're trying to be current. We don't want this to be your grandmother's attic.
We start with the ever-present question of inflation and where it's headed with Peter Borish, Chairman and CEO of Computer Trading. So, Peter, welcome back. Good to have you here. Every week we get new data on inflation, points one way or the other. But in a larger sense, you often look at what you call the 7 C's in commodities. What are those telling you right now?
First of all, thanks for having me. The 7 C's are relatively consistent that inflation is going to be persistent for longer. You're starting to see some of the seasonal commodities potentially break out. Cattle, 1 C. Corn, the other C, that have been relatively weak. The stronger C's, coffee, cocoa, and crude, they've been relatively stable after having fairly large moves.
And what's driving that right now? I mean, what are the forces? Why do you look at the 7 C's?
I look at them as the AC, which is the consumer. And in terms of, is the consumer going to have to substitute their spending for more on staples where demand is inelastic? And that then is going to lead to less discretionary spending across the board. And so then I look at bigger picture stocks like Visa, MasterCard, Costco, Target, to see if the consumer strength is still there. Those stocks have demonstrated a little bit of weakness. So that is the conundrum, the 9th C, of the pressure on commodities and potential weakness of these consumer stocks, which definitely puts the Fed in a box.
So if there's a breakout in some of the C's and the commodities, that puts pressure on Visa and MasterCard because people don't have as much money to spend at Target, for example. They have to spend it on food.
Yes. And so those stocks in particular are a good measure of consumer strength, and you see that in weekly data that you can get from JP or Bank of America, compares it week over week or year over year as the strength of consumer spending.
Now, some stocks that have really felt a lot of pressure just recently have been the big tech. What is going on with them, do you think?
Well, first of all, there's the trading aspect to it. So, there's the old saying, right? What goes up must come down. So you've basically had a really big move. You've corrected. Technically, a number of these stocks have broken key levels. And if they don't reject those levels and start their uptrend again, that could mean that the leading aspect of the technology relative to other stocks is ending, which can hurt the large cap indices because they're such big weights.
What does this all say to the Fed? I mean, I could speculate that actually a little bit of tightening financial conditions would not be a bad thing for the Fed right now because they've been going the other way.
I think the Fed is sprinting in place. Very, very challenging because you have this tug of war. But it's hard to say that you should be easing when you've just had record highs in Bitcoin, record highs in equities, and you've seen gasoline prices go up and potentially now these other commodities breaking out. So they're stuck, in my mind, of not doing anything probably the rest of the year.
Gold doesn't begin with the C, last time I recalled. But you talk about record highs. We've had some record highs in gold. Is that a useful indicator in your experience over time of where inflation might be heading? Because often you think that's where you go if you think you got inflation.
So I am not one that particularly favors gold as an indicator of what's going on with inflation. By the way, the correlation between gold and the S&P has been fairly high. So you would think, oh, that's a cross current. People tend to look backwards. So in the 70s, when gold was really strong and inflation was high, there weren't really a lot of other instruments to use to hedge against inflation. But today, there are many more instruments. You can short bonds in the futures markets. You can participate in individual commodity markets, or you can actually participate through options or futures in the equity market. So I don't think gold is as much of an inflation indicator as perhaps a supply and demand question for uncertainty in the global geopolitical, and then non-U.S. central banks may have added to gold demand recently. Of course, that too, in the last week or so, has had a pretty significant correction. Let
me come back to your ninth C, I think it is, conundrum, what you said.
Yes.
Okay, as an investor, how do you invest into a conundrum? What do you do?
So it depends on your time frame, right? If you're younger and you have a long time frame, then you sit back, and that's the nature of markets. On average, right, there's a double-digit decline in the S&P every year. Of course, I'm always mindful of the 6-foot-tall man that drowns in water an average height of 5 feet. So you have to be careful of averages because there are bear markets. But in that case, you stay the course. If you're more like me and you're a trader and you've had a good run, I think the hardest thing in portfolio management and discipline is selling a winner or taking it down and rebalancing your portfolio. Is this a time to rebalance your portfolio where you have this conundrum combined with Fed uncertainty? I think that makes a lot of sense.
Peter, it's so helpful. Always good to have you on Wall Street Week. That is Peter Borish of Computer Trading. Treasury Secretary Yellen traveled to China to criticize the government for subsidizing parts of its industry. But this week, the IMF leveled a similar criticism at the United States and urged Europe not to follow suit. To take us through where Europe stands in the apparent race to subsidize, we welcome now Stephanie Flanders, Bloomberg Senior Executive Editor for Economics and Government. So Stephanie, welcome back. Great to have you with us. So tell us about this wonderful world of industrial policy. Sometimes we criticize it, and it looks like right now the United States is embracing it. Where are we globally on industrial policy?
You know, this is one of those things where it's a fast-moving bit of economics, certainly of economic policy making. You know, for decades, certainly when I was first learning about industrial policy and economic policy, it's kind of a dirty word. Certainly capital I, capital P industrial policy, because it was the idea, maybe more popular in the 50s and 60s, that governments could spot strategic industries and invest in them. And the line I was always given that they were good at picking losers, they weren't good at picking winners, and that you could waste a lot of money doing that as a government. And if you were going to do it successfully, well, the only places that had done that were maybe places like Korea or Singapore, where you had highly effective states, and you had, you know, these were emerging market economies that had a path to follow. They could see what other countries had done, so they had less chance of getting it wrong. What's changed, I think, you know, like so many things, has been upended by the different geopolitical outlook. You know, that what you think of as as even, what a winner would be in a context where you could have in 10 or 20 years' time a decoupled global economy really changes. It could be you may have wasted a lot of money, and an economist might have said that is a big, you've inefficiently used those resources, you're not making profits, you've produced excess capacity of a good in the global market from doing this industrial policy. But if in 20 years' time you find that you're the only place with, say, a solar panel industry on one side of a big economic divide in the global economy, well, maybe all that quote-unquote wasted money will turn out to have been well spent. So I think everyone's having to kind of rethink what success and failure looks like in an industrial policy context. But we certainly could be in for wasting a lot of money with these subsidies.
Whether it's a good thing or a bad thing, how much of this do you think is triggered by China? Because China is now the second largest economy. Some things it may be on its way to first. It's certainly embraced subsidizing industry quite a bit. The Biden administration criticizes China a great deal for that. But it's an enormous amount of money. How much of it is the rest of us being afraid that they will overwhelm us?
Well, and I think it's not just the fear, right? It's actually the reality in some key sectors. I mean, the green technology is a classic example. We're now looking at how much, Chinese EVs, electric vehicles, are just sort of swamping the global market. A lot of subsidies have certainly gone into that. The European Union announced an investigation into EVs. They've already been burnt when it comes to solar panels because the European Union had invested a lot in wanted to have a big domestic solar panel industry, was just wiped out of the water by China. There's the sheer scale of Chinese production. Now 90% of solar panels in Europe are made in China, and actually a very high proportion in the US as well. So, China is driving this, but of course, if you're Europe, it's also the Biden administration's response to China. Things like the Inflation Reduction Act. The Europeans have felt like they had to have their own thing. They announced the Net Zero Industry Act last year. It was very explicitly about building the European domestic green energy systems and products so that they weren't going to end up reliant on China.
And how much pressure is there on Europe? Do they need to do some sort of large fiscal infusion to really get competitive?
I mean, I suspect certainly the International Monetary Fund would say it is as much about developing the single market and working as a cohesive block as it is about spending lots of money. Yes, there's going to need to be a lot of investment funds for green technologies, for decarbonising the economy, potentially for taking advantage of digital technologies that Europe hasn't been able to do as well as the US.
Stephanie, it's always so good to talk to you. Thank you so much. That is Bloomberg's Stephanie Flanders. Coming up, is America finally going to get one of those high-speed trains we've envied in France and Japan? We talk with Wes Edens about his bold new Brightline venture that broke ground this week.
We think that the adoption rate for it is going to be rapid.
That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. The United States took a big step toward high-speed trains this week when Brightline West broke ground on a $12 billion project to build a rail link between Las Vegas and Los Angeles. And we welcome now the founder and chairman of Brightline. He is Wes Edens. Wes, great to have you with us. Thank you for joining us. To tell us about this project, Brightline West, it's the second Brightline project after Florida. Give us a sense of how big a business this is in success.
First of all, thanks for having me on, David. It's a great time for us. It's a great time for the rail business. And so we, as you said, we broke ground earlier today on Brightline West, which is the second train project for us. But it's most notably, it's the first high-speed train, true high-speed rail that'll be built in America. And that's a big deal and a monumental occasion. And I think actually even a bigger deal is I really do think that this is now the beginning of the high-speed rail industry in the U.S., which I think has got, massive, opportunities and growth in front of it. So it's a really exciting time.
Given your investment tracker, you've checked how much demand there is out there potentially, and you've concluded it's big enough to support this and make it a good business. How much demand is there?
There's about 50 million trips that happen between Los Angeles and Las Vegas every year. About 85% of those happen by car. And I don't know if you've ever done the drive from Las Vegas to LA, but it's a notably difficult drive. It's probably 4 hours in the best case. It's very, very unreliable in terms of what the time actually is. And so there's a tremendous amount of demand between these two cities. There's only one way to get there, which is on I-15. And so our train is going to go right down the middle of I-15. And we think it's going to have a massive amount of demand from people that make that trip.
This is not your first foray. You have Brightline up and running in Florida, right, between Miami and Orlando. What have you learned from that will change what you do in Brightline West?
Well, I'd say most notably we learned that people like trains, right? So we have millions of people that ride our train down there. The adoption of it in South Florida and now up to Orlando has been terrific. We opened the route from Miami all the way to Orlando recently. It was actually last September. The numbers have been fantastic, and we're very optimistic about the future of that train. The biggest lesson, I'd say, is that when we built that train, we basically use the existing rail corridor for a portion of it. So basically from Miami up to Cocoa Beach is kind of a straight shot from south to north. At that point, you turn left and then go across Route 528 to the Orlando airport. That's how the route is made. What we did, that because we had access to the train, it was version 1.0, as I said, it makes a lot of sense. But there's a lot of things about it that we think can be improved on. In particular, there's a lot of rail crossings there, because it runs up really US Highway 1. So this train from Vegas to LA will site it in the middle of I-15. It's a big 200-foot wide corridor, put it right in the middle of it. And because of that, you can put a fence around it, you can electrify it, no rail crossings, you can go true high speed. So north of 200 miles an hour is kind of the objective. And that version 2.0 is what we think makes sense for this corridor. And I think it's a good blueprint for what we should find success with in other parts of the country as well.
What's the time horizon you're looking at for these investments? I believe you're cash positive in Brightline out in Florida now. But you haven't recouped the investment yet, but you're cash positive. How long until you actually recoup investment in Brightline, or for that matter, Brightline West?
I think from this point forward in Brightline East, it's all systems go. We're adding more capacity this summer in June with more train cars, the same in the end of the year in December, and the same again next year. And so with that, you'll then get to higher ridership levels, higher revenues, and we think that that's a time in which we'll start to look at, different alternatives in terms of financing, bringing in equity, et cetera, et cetera.
Do you have a sense of when you would bring in other investors?
Yeah, we have brought in, modest investors. I mean, I'm a large investor in it personally, so I'm a big believer in it. I kind of eat my own cooking, so to speak, with it, and have for a long time. I think that it's an investable, project now, and so the groundbreaking today, I think, signifies kind of the next layer of it, and I think that there will be some investment opportunities both in the debt and equity side in the upcoming kind of months between now and the end of the year. And then I think as you get under construction, I think that there's lots and lots of different opportunities to grow the business, because this is something that clearly can be replicated at other city pairs around the country.
Tell us about the government role. We had Secretary Buttigieg come out for the groundbreaking for Brightline West. How critical is the government? Can these happen without the government really supporting them?
I think in the long term, the answer is absolutely yes. But I think that there's lots of examples of government playing pivotal role to getting new industries off the ground. So if you look at the history of, Elon Musk with his SpaceX, or the electric vehicles, or, subsidies for the solar business, there's lots of examples of things that started out being subsidized and then turned into be, big, robust businesses. And I think the train is going to follow those same footsteps. So, when you say government, there's many governments involved. So it's really a coalition of local governments and state governments and federal governments, all of them playing a big role. Obviously, the federal government and the Department of Transportation, providing a $3 billion grant was a huge part of this. But frankly, so were, the delegations from Nevada and from California. Frankly, the governor in Nevada, Governor Lombardo has been an incredible supporter. The DOT, the Department of Transportation, is our partner in Nevada for this project. So, I like to think that it takes everyone to say yes and only one person to say no to derail these kind of projects. And fortunately, we have such a compelling project that we've actually had nothing but yeses. So it's a really good position to be in.
Okay, Wes, thank you so very much. That's Wes Edens. He's chairman of Brightline and Brightline West. The arts, including music, museums, photography, and more, contributed over $1 trillion to the U.S. economy in 2022, according to the Bureau of Economic Analysis. And New York in particular is known for its performances and museums. But the very nature of the arts is going through fundamental changes in what is presented and in how it is paid for. Changes triggered in part by a pandemic that forced most of us to stay at home. Sir Clive Gillinson has been the executive and artistic director of Carnegie Hall for nearly 2 decades, and he remembers well the dramatic moment when his legendary concert hall was once again open for business.
One of the most moving things is when we opened again after COVID, the emotion in the hall was astounding because Robert Smith, our chairman, and I thought we should speak to the audience on the opening night. And I literally said the first 2 words, which were "welcome back." And the place exploded.
Welcome back to Carnegie.
And that emotion has carried through. So firstly, I think the whole thing of live music and the impact of live music, that is in the greatest possible shape. And, and people love it, care about it, and I think they even today, that emotion is still there about how they now value it in a way where you only value something when it's taken away from you.
Are you, Carnegie Hall, fully back from the pandemic?
Yes, the first year we had a reduced number of concerts. Last season and this season, it's the full number of concerts. We're back to the normal number of presentations. And audiences are averaging 93%. So fantastic response to what we're doing. And there's a real feeling of engagement with the music in a very powerful way.
It wasn't just performing arts centers like Carnegie Hall that were hit hard by the pandemic. Tony James of Jefferson River Capital serves as co-chair of the Metropolitan Museum of Art, a position he came to when the pandemic hit, and hit the Met particularly hard.
The Met, for example, lost $100 million of revenues over the 2 years. So that's hard to recover from. A lot of the art scenes in New York depend on tourism. Our attendance from locals are all the way back. Our attendance from tourists are only in the 70s, and particularly Asian tourists. That's where we're really short. And so it's a bit of a struggle. We've had to find new revenue sources. We've had to be careful about costs. But I think, as we've discussed in the past, David, I think arts are what make New York the gateway city, the wonderful city that it is.
The success of a great arts center like Carnegie Hall or the Metropolitan Museum requires a balance between high culture that appeals to changing audiences and running a very large business with all the challenges of managing costs and attracting revenues that any CEO of a big, complex company would understand.
One of the things that strikes me is your title. You're executive and artistic director. It reminds me a little bit about the division between a publisher and an editor in a newspaper. You have both. You're responsible for the business, as it were, of Carnegie Hall, as well as the artistry. Give us the sense of the balance. How do you get the right balance between the business side and the art side?
I mean, it's a really interesting question because most organizations separate the two. The reason I would never, ever do a job which was half of what I do is because I feel if you're involved in the artistic, you want to be as expansive and imaginative and take risks and really travel extraordinary journeys with the music. Now, if you're the person responsible for the money, you're probably going to be cautious and keep saying, I'm not sure we can do this, I'm not sure we can do that. The good thing about doing the two together is if I want to dream, I've then got to be part of making sure that can happen as a business. So in a way, I think it enables you to take far greater risks because you're responsible for both.
You've been known throughout your career for taking some risks. I mean, you were, of course, a professional cello player back in the London Symphony Orchestra.
Well, that was somebody else's risk, having me as professional cello player.
But then you stepped up, not necessarily volunteering, but you stepped up to really take over a struggling organization, and you took risks from the very beginning. You've taken risks at Carnegie Hall. How do you get the right balance between taking a risk and, as it were, not falling off the high wire?
Well, I mean, of course, the key thing about all risk is how you manage risk. I mean, you can't live without risk. And so, there's a famous saying, which is, if you're not living near the edge, you're taking up too much space. Money follows vision. You always go for the vision. Go for something that is irresistible, that has to happen. And then there's a chance you can sell it to somebody else. If it's good, and the world can live without it. I mean, it's very nice for it to happen. If it's only that, it's very hard to sell to somebody else. It's got to be irresistible.
Over at the Metropolitan Museum, Tony James says that the mission is to show the world great art. But to do that, it needs to generate a great deal of revenue each year to support the facilities, including the 2 million pieces of art the Met owns, only 15% of which are on display at any given time, and to mount more than twice as many exhibitions each year as any other museum in the world.
About 30% of our revenues come from people paying to go in, buying food, buying stuff in the store. So let's just call that revenues, members as well. So that's about 30% of revenue. About 30% of our revenues comes from spin-off from the endowment. We spend about 4.5% of the endowment each year, but that's very restricted because people give, I'm giving this money, but the interest on it can only be used to buy Renaissance art or something. There's fun digs in Egypt. There's all kinds of strange things. And then about 40%, the remaining 40% comes from contributions of different sorts. The problem the Met has is one of the great things about the Met, depending on how you want to look at it, we sit on city land. It was given 150 years ago, but we sit on city land. And the deal was that city residents can pay what you wish as you come in. So the average city resident pays less than $10 to come in for one of the biggest museums in the world. They can spend days there or weeks there, and whereas a tourist pays $28. So when you lose your tourism, you lose a lot of the revenue-paying people, honestly. And so that's been a challenge.
Coming up, we'll take a closer look at how centers of art and culture are changing what they present to adjust to changing audiences and what lies ahead in an increasingly digital world. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. There's more to sustaining the cultural center of New York than presenting great art. Institutions like Carnegie Hall and the Metropolitan Museum must respond to the changing city and culture around them, reaching out to new communities and adapting to the new forms of expression that the digital world makes possible. And perhaps most of all, using the art to tell compelling stories for all of us.
We have transformed the hall. Firstly, we do much more storytelling. We started big festivals when I began, and one of the earliest things was I asked Jesse Norman, an extraordinary singer, to create and curate a series about African American culture. And we've looked at a number of big stories. We've looked at migrations and how migrations created American culture. We've looked at Afrofuturism. We've looked at the role of women in music, but more generally across the whole of culture. Now, currently, we're looking at the fall of the Weimar Republic and using that as a lens to look at the fragility of democracy all around the world. Big issue of our day. Next season, we'll be looking at Latin music. So a huge amount of storytelling, and that's only one dimension.
I suppose if you're a tourist and you've never seen Van Gogh's Haystacks, you want to go see them in person. But because so much of our audience is local, and we want them not to go once a year or once every 3 years. We want them to go every month. We want them to come back. So we have to have things that they want to go see that's current. I just got back from Berlin last night, as you know, and they've got a wonderful contemporary art museum there, and it's got beautiful paintings of one Picasso and one Magritte and this and that. It's a lovely collection of random, if you will, but very high quality contemporary art. But there's no theme to it. There's no story. We're trying to create things that have a story so that people want to come. Oh, this is, the rivalry between Degas and Manet and how they fed off each other. And they were both friends and at one point enemies. And how Manet cut Degas out of one of the paintings. And get them interested in the narratives. And the Harlem Renaissance Show has been a huge success of celebrating that whole wave of culture that's centered in New York about the strength of African, the wonderfulness of African American culture. That's been spectacularly successful and was not very well known. That's what gets people's interest. It's not just seeing an object.
As important as it is to preserve the best of what is time-honored in the arts, it's just that important to recognize great art that is being created to the present day and in places that go well beyond the traditions we've lived with for so long, especially as the profile of audiences continues to evolve.
What is your sense of how the profile, and I'll say demographic profile, of your audiences has shifted over that nearly 20 years?
It's hard to say. We have so many audiences because we do so many different things. We're the best of every sort of music, or we aspire to be. And So, I mean, there's some audiences which are very young. I mean, for instance, our Afrofuturism audience was very different, and some up to 70% had never been in Carnegie Hall before. So, with each project, we develop new audiences and then we try and keep them as part of our audience going forward. I think the audience has grown in terms of diversity, but diversity meaning, not only race, but age, men, women, nationalities, everything. And we want to be and represent the best of every sort of music, which means that we're going to be relevant. I mean, there's something like 180 nationalities in New York. I mean, insane. It's the most diverse city in the world. But we want to be relevant and meaningful to everybody.
If you think about what's called the Western canon of art, so the traditional artists, they're all white male artists. A lot of them were from Europe, all the way back to the Middle Ages, from the Renaissance, to the Impressionism, Old Masters. Not a lot of diversity in that group. And then we had sections of the museum dedicated to the arts of the Pacific and Asia, for example. But they were very discrete parts of the museum. I think the greatness of the Met is that we can integrate all these things.
If we went back 20 years ago and looked at the nature of the performers appearing on the stages here at Carnegie Hall and compared to today, how would it be different? How are you getting new young talent and where's it coming from?
Well, we all the time, part of our job is obviously to bring, the most extraordinary established performers here. But at the same time, we are always looking out for the most brilliant young players. So a few days ago, we had somebody called Yan Chan Lim who won the Van Cliburn competition. He was 19, he's just turned 20, so now he's an old man, of course. But he came in, it was sold out weeks in advance. He's a dazzling player. I mean, he is going to be part of our life for the next 50, 60, 70 years, probably.
What we think of as the traditional patrons of the arts remain key to success of a place like the Metropolitan Museum. But they're now being joined by a new, younger, and more diverse group of supporters.
We're building a new modern contemporary wing. It's going to be a really exciting project for the city, $600 million. You could spend $200 million on one Giacometti sculpture if you had to buy it. And we got to fill an entire wing of modern art. So we depend on collectors, usually at the end of their lives, giving us their collections or parts of their collections. So that set of givers that hasn't changed very much. That's still not very diverse. It's old, it's predominantly white, it's very wealthy, almost definitionally. But the people that come in and give cash or go to benefits, that's young, and we make every effort to make that younger and more exciting and hipper. We're trying to be current. We don't want this to be your grandmother's attic.
For true centers of art, it's not enough to be great programmers, to present works in compelling ways that tell stories. Beyond featuring what people have already come to appreciate, they also play a key role in educating us all in what we haven't seen, what we have yet to appreciate, what is new, what is different, and what is coming around the corner.
For me, education is not about audience development. Education is about giving every child the opportunity to have access to music. So we've got programs that are all around the country and serve kids everywhere. I mean, we now reach 800,000 people a year with our education programs, probably the bulk of those outside New York City. But if those people never come to New York, I think we've succeeded as long as music can be part of their life. Whereas if you were looking at it as an audience development, we would have failed miserably.
So you'll forgive me, this is Bloomberg, so we like to think of the business model too.
Right.
When you talk about educating 800,000 kids, how do you support that? Where's the revenue for that?
Well, I mean, there's two things. Firstly, to create it, you have to have partnerships. So we have partnerships all around the country with people who share our values. And you can't have partnerships without shared values. So we do all of that, and then we have to raise a huge amount of money. I don't know the exact amount we spend on education every year, but out of a budget of about 120 million a year, I would have thought we spend probably at least 15 million on education, which is not much less than we spend on presenting concerts.
Like every business and institution, art centers are embracing what digital technology makes possible, expanding their reach and exposure to people in New York and around the world, such as, for example, Carnegie Hall's new streaming service called Carnegie Hall Plus, providing us the opportunity to enjoy great music in the comfort of our homes.
It's on Apple TV, it's on Amazon, Comcast, it's on 10 different major platforms, so it's available to every home in America just about now. We're also going more and more international. And my view always is, here we are. I mean, even though it's, such an extraordinary city, New York, I don't know. I mean, what is it? Probably 95% of the world's population will never come to New York. So what we do needs to be available everywhere to everybody. I never think that digital is a competitor with live. The live experience is the greatest possible experience. It's of the moment. It's being created for you at that moment. You're sharing it with other people. There's something magical and special about a great live performance, which is inspirational. But if you can't have access to that, then to have access digitally is a fantastic opportunity which we should give people as well. But it is not a replacement. So I never worry about digital being something that's going to undermine people's wish to go to live performance.
The Metropolitan Museum is also using digital technology to gain more ready access to audiences around the world. But it's also designing a new wing of the physical museum with the future evolution of technology very much in mind.
We're trying to digitize every one of our significant pieces of work in high def and make that free to the world. And our mission is to show the world great art. And it's not everyone's going to be able to afford to travel to New York. So we have to make that available to them digitally. The big question is when you build a new wing is like, what's technology? This wing has to last 100 years. So what are we building for?
Finally, one more thought from Sir Clive Gillinson, Executive and Creative Director of Carnegie Hall, about the hall itself, how it came to be, and what makes it an icon for performers of all sorts the world over.
I genuinely think it's the greatest concert hall in the world, which is completely baffling.
In terms of acoustics?
Yes.
That's what I've always heard.
And I mean, what is astonishing is, because of the size, it's 2,800 seats. Most concert halls are 2,000, and yet it feels completely intimate wherever you sit.
It does.
And people who sit right, because students will sit right up, well, you'll see it from the platform, right at the back, and you can hear it as if it's in your living room. If you look up there,
how far
they can hear as well as anybody else in the entire hall.
It's a mystery.
And you could have a massive orchestra making a huge noise, and it works perfectly. It can carry any sound, any amount of sound, and yet you could just have somebody playing a lute here, and you can still hear every sound.
So what goes into making a concert hall one of the greatest in the world? It turns out pretty much everything.
Well, the reality is, you cannot replicate a great concert hall because every single thing counts. The density of the plaster on the wall matters. The carpet, what the padding in the seats is. We send these seats back to Canada, to the manufacturer who made them in 1891, because nobody dares touch anything that could affect the sound. So they go back to the same place that they were made 130, whatever it is, years ago, and so on. Even when you have to put wires in the walls, the fact that you'll be changing the plaster, you've got to be careful that you try and get the right density of plaster.
But the unique combination of qualities that have made Carnegie Hall a legend around the world came together almost by accident, created by someone unknown as an architect who'd never done this before, to please the wife of one of the world's richest men.
And this guy had never built a concert hall in his life.
Well, one of the things I read, you can tell me if it was wrong or not, the fellow who was the architect was actually a cellist.
He was.
He played cello.
Which, of course, is the reason why he was such a great architect. He was the treasurer of Louise Carnegie's Choral Society, because she sang, Louise Carnegie sang in the Oratorio Society. There was no decent concert hall, so she said to her husband, as you do, would you build us a concert hall?
That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.